Welcome back to Kuwaiti Dinar Analysts, where we explain how global events influence currencies, oil markets, and national economies without fear or hype. Today we're answering a question that's on many minds. If the US were to attack Iran, could oil prices explode, and why would that happen? Before we begin, it's important to state that this is an economic analysis, not a prediction or speculation. We're here to break down the mechanics step by step. Let's get into it. First, let's cover the basics of the global oil market. Like any commodity, the price of oil is driven by supply and demand. The world's supply is heavily influenced by major producers, including countries like Saudi Arabia, Iraq, the UAE, Kuwait, and of course, Iran. These nations play a huge role in determining how much crude oil enters the global market. Now, energy markets are extremely sensitive to disruptions in supply. This is especially true when those disruptions come from a region that ships a massive share of the world's oil. As reported by S&P Global, when supply is interrupted, or even just feared to be interrupted, prices can react very, very quickly. It's a market built on both physical barrels and perception. So why does Iran matter so much in this equation? While Iran may not be the single largest exporter on any given day, its strategic position is critical. It sits directly beside the Strait of Hormuz. Think of this as a major global highway for oil. According to ING, about 20% of all seaborne oil passes through this narrow channel. Any disruption there sends ripples across the entire world. On top of that, Iran itself produces hundreds of thousands of barrels of oil daily. It also has significant influence over regional dynamics, affecting allies and other key shipping routes. So any serious conflict involving Iran wouldn't just be a local issue. It would directly impact global trade and energy flows. With that in mind, what happens to oil supply during a conflict? When markets sense a potential disruption to supply, they start to price in what's called a risk premium. This is an extra amount that traders add to the price of oil simply because of uncertainty. This can happen without a single barrel of oil actually being lost. The mere fear of a future disruption is enough to drive prices up. Analysts use terms like the geopolitical risk premium to measure this effect. We've seen this happen before. In past escalations, oil prices have shot up rapidly right at the beginning, even before any real supply cuts occurred. For example, after attacks on Iranian targets, Brent crude jumped as markets priced in that new supply risk. This is how financial markets anticipate problems before they fully materialize. They trade on what could happen tomorrow, not just what happened yesterday. Let's explore the risk of retaliation and how it could interrupt trade routes. If the US were to attack Iran, there's a possibility of retaliation that could specifically target the oil market. Potential actions could include hitting vessels in the Strait of Hormuz, targeting oil infrastructure in neighboring waters, or fueling proxy conflicts that disrupt regional trade. When strategic choke points like the Strait of Hormuz are threatened, even small delays or minor incidents can send prices significantly higher. History shows us that both actual disruptions and credible threats to these routes can push oil prices well above their typical trading ranges. The security of these sea lanes is fundamental to stable energy prices. So, let's look at a few potential scenarios that analysts have discussed. First is what we can call a short-term shock. In this scenario, prices would jump moderately, perhaps by 5 to 10%. This happens when fear spikes, but the actual supply of oil remains largely available. The market reacts to the headline news, but then may calm down if the flow of oil isn't cut off. The second scenario involves actual supply cuts. If Iran's own exports are limited, or if energy infrastructure in the region is damaged, prices could rise more significantly. We could see oil move towards $75 or $80 per barrel, or even higher, depending on the broader market conditions at the time. The third scenario is a major disruption. If the Strait of Hormuz or other major shipping routes were seriously disrupted for a prolonged period. Some analysts believe prices could climb substantially higher, potentially even above $100 per barrel in a severe case. The outcome of any of these scenarios would depend on the duration of the conflict, the response from OPEC and other producers, and the ability of alternative supplies to compensate for any losses. This brings us to the role of other Middle East producers. Major exporters like Kuwait, Saudi Arabia, and the UAE hold what's known as spare capacity. This is the ability to increase their oil output on short notice to help stabilize markets during a crisis. In the past, OPEC Plus has used this spare capacity to act as a buffer, preventing prices from spiraling completely out of control. This potential buffer helps limit how far prices might spike, but it's important to understand that it cannot eliminate all risk. Even with extra supply coming from OPEC, prices can remain elevated due to those risk premiums and ongoing fears about transportation security. It's a powerful tool, but not a perfect one. Finally, what would be the global economic impact of higher oil prices? It affects everyone differently. For consumers, it means higher costs at the gas pump. For countries that import a lot of oil, it can drive up inflation and slow down economic growth. On the other hand, for strong oil-producing nations, higher prices typically benefit national revenues, at least in the short term. It creates a clear divide between energy exporters and energy importers. For nations that depend on imported energy, a sustained price spike can squeeze government budgets and put a brake on their entire economy. So, to return to our original question, could oil prices explode if the US attacks Iran? The answer is that prices could indeed rise significantly, especially if the conflict threatens supply routes or creates widespread uncertainty. But the extent of that rise depends on several key factors: the scale of the action, the supply response from OPEC and other producers, and whether key sea lanes like the Strait of Hormuz remain open. This isn't about panic. It's about understanding the structure of the market. Global markets move on risk and supply fundamentals, and a conflict in this region touches on both. If you found this analysis useful, subscribe to Kuwaiti Dinar Analysts for clear economic explanations without exaggeration. The strongest economies aren't built on fear, they're built on understanding. Thanks for watching.